What's up, everyone? It's Scotty with MoneyVest. So today we are going to be talking about the unemployment numbers that are going to be coming out in the upcoming week. So next week is going to be employment week, so labor week, because we've got the JOLTS numbers, we've got the jobless claims, of course, coming out every Thursday. We've got the unemployment numbers and the ADP employment numbers coming out. ADP numbers come out on Wednesday, and the actual non-farm payrolls from the Bureau of Labor Statistics come out on the first Friday of every month. There were some concerns over a government shutdown and that report getting delayed or missed altogether. But of course, we know the 45-day shotgun process of government expansion with the Congress passing in a very emergency process. We know that the reports are going to be released on time with the Bureau of Labor Statistics. And exactly that's what I want to cover in this video. Go over the JOLTS numbers that's also going to be coming out, and of course that ratio, and the unemployed persons, which we are also tracking, because the jobless claims, as I've mentioned before, is one of the most leading indicators that we can watch and pay attention to when it comes to a potential for a recession. So hope you guys enjoyed this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to that 16% annual discount that's available. You get access to all the buy and sell alerts, options alerts, trade ideas, members only private videos. Everything is going to be included with the link down below, and we'll love to have you on board. If you have any questions, let me know and I'm happy to help. So this right here is going to be the economic calendar. So JOLTS numbers are going to be scheduled for Tuesday at around 10 a.m. Eastern. So that's going to be coming out next week. We've also got the ADP non-farm payroll, so employment report reported by ADP, which is again a private company that has a lot of businesses on their using their services to run their payroll. And of course, we've got the jobless claims every Thursday at around 8:30 a.m. Eastern. And this right here is going to be the important report on Friday, October 6th, which is going to be employment situation. So in other words, the non-farm payrolls and the consumer credit report also comes out on the very same day. Now, when it comes to the employment situation, this is going to be the consensus for next week. So if we basically take into account the non-farm payrolls, we are expected to add about 160,000 jobs, and the unemployment rate is expected to basically drop down to 3.7%. And private payrolls at 150,000. We've got manufacturing payrolls at 5,000, and the average work week at 34.4 hours, so unchanged, and average hourly earnings to increase 0.3% month over month, and year over year sitting at just over 4.3%. So that is going to be that consensus for unemployment numbers next week on next Friday, October 6th. This right here is the report that we have already talked about. I'm going to briefly break this down once again so you all have a very good understanding on where we are with respect to where we have been in the past in 2020 during COVID, 2008 during the great financial crisis, 2000 during the dot-com bubble, and of course the great inflation of 1970s. But last but not least, the jobless claims consensus is going to be 210,000, and the ADP number is going to be 150,000, and the JOLTS are expected to increase to 8.9 million. That is a very, very important number because this basically represents the supply of jobs. In other words, how many job openings there are. And the unemployed persons basically tells us how many people are currently unemployed, right? So our leading indicator, there's two of them. One of them is the jobless claims. As I mentioned, that this number, as it starts to tick higher and higher, that's when it starts to become a bit of a problem. And right now, unless it's, over 300,000, it's not really that concerning for me. The moment it starts to, trade back above 300,000, that's when, in my opinion, it will start to become a bit of a problem. So this right here is the initial claims. And you'll notice that if I basically put up a line for this, that is going to be somewhere around that 300,000 level. So close to this level right here. We've been trading below that. I mean, we're even lower. We're closer to 250, 260,000. So this right here has been the range within which jobless claims have been since literally 2021, since November. So we've really come down. There hasn't really been a big breakout past the 300,000 or 260,000, I should say, on a week over week basis. But the moment this starts to push higher is when the problem begins. And another interesting thing that I want to point out is that stocks actually bottom before the jobless claims peak. Now, this happens during recessions, right? During recessions, during bear markets, and we're not there yet. And as I've mentioned before in one of my previous videos, that jobless claims, once they start to move higher, right, that basically tells us the labor market is weakening, right? It is not centering by any means. It's weakening because there's more and more people filing for unemployment benefits, insurance claims for unemployment, and it starts to move higher. And well, guess what? That's what's going to drive the unemployment rate higher as well. And when that happens, that is one of the leading indicators I mentioned before, is for a recession, right? That's a leading indicator because more and more people are unemployed. Well, guess what? They're not going to be able to make their bills. They're not going to be able to pay for the services, pay for goods and services. And that's going to lower the earnings. And the companies could be like, you know what? We're going to start laying people off because we need to tighten up our budgets. We need to do these cost cutting measures because of the lower earnings, because people are not spending again. And as a result, more layoffs leads to more decline in spending, leads to lower profitability, leads to lower productivity, which obviously leads to a real economic recession. So time and time again, I've mentioned that labor market, the jobless claims and unemployment numbers it's a leading marker for a potential recession. That will tell you everything. If you can predict where the labor market's going to be 1 year from now, you will have a very good understanding on where interest rates will be, where inflation will be, where the economy will be a year from now. So unemployment will tell you everything, right? So this right here is the spreadsheet that we have talked about. So right now, the total eligible workers in the US is sitting at 266 million. The participating population is around 166.5 million, and the participation rate is 62.6%. Unemployed persons is 6.36 million. So if this right here is the chart that I'm referring to, 6.355. So that's the number that I've plugged in over here, which is going to be over here as well, 6.355. And what this does is that it takes into account the unemployed persons total based on the participating population. Again, total eligible workers are 266 million, but of those, participating population is 166.5 million, because we know that many people could be in school, many people could be disabled, many people could be retired. So even though they are over 16 years of age, which is about 80% of the population, and they are eligible to work, only 166.5 million are actually participating actively in the labor force. And of that participating population, 6.36 million are currently unemployed, which basically brings us to this 3.8% number, which is the unemployment rate right now, as we have also discussed in our previous videos, and that's exactly where the rate is right now as of August 2023. Now, the moment this number starts to increase, which is the unemployed persons, right? Look what happens when I switch it up to 7, right? 7 million, that number unemployment rate jumps to 4.2%. The only way to keep this number below 4 while increasing the unemployment rate is that if more and more people start participating. So if this number goes up to, let's say, 170, you'll notice that it drops down to 4.1. If this number goes to 180, you'll notice that it drops back down to 3.9%. So if more and more people start participating in the labor workforce and there's fewer, in other words, there's, as a percentage basis, there's still 6 or 7 million people unemployed, then that unemployment rate will not change. But we know that this has been the more consistent participation rate, 62, 60%. We're never going to have 80, 90% of eligible workers participating actively in the workforce. So this is more of a fixed, not really a fixed, but very much been a range-bound number between 60 and 62%. So even the more sensitive moves in the unemployment persons, let's say 7.5 now, right? So that number jumps up to 4.5%. If we get to 8 million, we're looking at 4.8. If we get to 10 million unemployed persons, we're looking at a 6% unemployment rate. But of course, we're not there yet. We're at 6.36 million. Now, the Federal Reserve is also going to be looking at these numbers, and they are going to make their decisions, of course, depending on where inflation is and where unemployment goes. But this right here is another really important ratio that they are watching very closely, which is the ratio of JOLTS numbers, which is the number of job openings with respect to the unemployed persons. So right now the consensus is 8.9, right? And the unemployed persons is 6.36. The ratio is 1.4, meaning for every one person that's unemployed, there is 1.4 jobs out there. But of course, there are different types of jobs, there are different pay grades, different education, different demographics, all those different things. So that's why we haven't been able to fill that gap of the JOLTS, which is 9 million jobs, almost 9 million jobs available, and 6.3 million people unemployed, and yet we're not able to fill that gap, right? I mean, ideally, we should have had all these people employed, but this is definitely a bit of a mismatch in the job openings and the type of job openings versus the type of employees that are looking for work. So because of that, imbalance here, ratio is at 1.4. Of course, this number's come down dramatically from over 2. At one point, it was 2.5, right? So at one point, I remember Joel's number was at 12, and of course, the unemployed persons was at closer to 4 or maybe 4.5. We were looking at 2.6, right? So this number was really, really high. And with higher interest rates, what's happened is there's been fewer and fewer job openings. and there's been more and more unemployed persons. So what's happening is job openings are going down and unemployed persons are going up. And so that ratio is coming closer and closer to 1. The moment it drops below 1, right? So the moment it starts to get up to, let's say unemployed persons goes up to 8 and Joel's numbers drop down to 7, now we're looking at 0.88. That's when the Federal Reserve will start thinking about potentially cutting rates. Remember, I talked about this in my previous videos, is the Federal Reserve needs an incentive. They need something in order to justify their rate cuts. They're not going to just wake up one day and be like, you know what, let's just go ahead and cut rates today. That's never going to happen. They need a reason. The only time they cut rates is if there is a recession, right? If there is inflation coming down pretty dramatically, right? We're getting into a deflation type environment, or if there is a significant crisis, right? That's why interest rates get dropped down to almost 0% instantaneously, because they always take staircases up. So you can see that they go step by step and then they take elevators down. That's always happens with interest rates. So they need a reason, and that reason potentially could be the labor market weakening, and that Joel's numbers to unemployed persons ratio dropping below 1. That means now there's less jobs available for the unemployed persons, and the unemployment rate also is going higher. So 3 indicators in the jobs market to look forward to. Number 1, jobless claims. Very, very important leading indicator. The moment it passes over 300,000 is when I will start to become a little bit more alert, and it will be more concerning from a recession standpoint. Number 2, unemployed persons, because that is directly correlated to the unemployment rate. And number 3, the ratio, the Joel's to unemployed ratio is what's really going to be driving that potential move for rate cuts from the Federal Reserve. So I hope you guys enjoyed this video. Again, we went over the consensus. I went over the 3 indicators, leading indicators in my opinion, to watch from an unemployment standpoint. Hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. Make sure that you do check out the links. You get access to all the members only benefits, members only private videos, a lot of tutorials, spreadsheets, and of course buy and sell alerts, options alerts, trade ideas. Everything's going to be included with the link down below, and access to entire server of our Discord. So happy investing, and I'll see you all in the next video.